Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to a new episode of the Capital Mind podcast. Today's episode is the Jane Street episode. We're going to look at the recent SEBI accusations against them, how Jane Street has responded, and then try and opine on the issue whether Jane Street was more of a smart investor with deep pockets who took advantage of perhaps an underregulated market and naive investors, or whether they were disproportionately manipulating or using unfair trade practices to lose money on one hand and make a lot more on the other. While at it, we're going to take a look at the role that index manufacturers and their indices or indexes play in the market, how they've become increasingly influential and in some ways are perhaps the largest fund managers or proxy fund managers out there today, and how they need to involve with more transparency, regulation, or perhaps even competition. So do listen in for a very fascinating conversation with Deepak. Hi Deepak. So this is the second time we're doing this.
Second time, lucky.
Thanks to a corrupted SD card, we are having to have this conversation again. But it's all for the best, if you ask me, because a lot has changed on the Jane Street subject matter since we recorded the first episode. So I think this one can provide a more holistic picture. And given the way things are, we might actually have to do another one many months down the line when there's the first round of decisions or legal proceedings completed on this case. But chalo, let's get into it. It's been a few weeks since the, can I say, bombshell report and fairly large fine that SEBI pushed out. It's a particularly well-written report. Many of us have gone through it. And SEBI has essentially fined Jane Street a lot of money, accused them of, I think it's unfair trade practices or something, and asked them to, attempted to ban them from markets, which of course they have now tried to get back at. So I thought maybe we could just sort of warm up by you telling us, your article has gone fairly viral on this, and so we'll certainly link to that. But can you tell us, what is Jane Street accused of doing? Just talk us through the what went wrong, and maybe answer this question of, look, is this actually a problem in the sense that the game is rigged and the regulator or Indian retail investors or someone need to be upset by this? Or is it just like law of the jungle? I mean, the person who has more money, I mean, obviously they have bigger pockets and they just take advantage of that. Where do you stand on that question too?
So let me answer that first. I think the game's always been rigged in the favor of people who have more money in general. It could be, let's say, a small cap manager of some sort that at the end of the month decides that in the last 10 minutes of the day he's going to buy a lot of the stock with whatever cash he has, and the stock prices go up. His NAV gets marked to this higher price, and therefore you get a much more, let's say, juicy NAV that you can report at the end of the month, and you kind of lift up the price. Nobody's really hurt because you've just bought more shares and things like that. But it is in that sense a little detached from reality. To a large extent, we've talked about this earlier also. Liquidity has a problem. So you mark something to market at 100 doesn't mean that you can sell it at 100. It's like saying, at some level people were saying, Bill Gates is the richest person in the world because you own some 40% of Microsoft.
But this was a long time ago.
He probably doesn't own that much right now. But if he had tried to sell 40% of Microsoft at any point during that time, it would have not been worth that many trillion or billion dollars, because immediately the price would have fallen by 40%. So it's not worth marking to market, but it's taken him a long time to be able to sell really slowly and things like that. So those are anyway, market valuations are figments of imagination at some point. If everybody sold, then you would not really get those valuations. But the idea of chapoing or printing a price has existed for a long time. I was in a broker's office in 2008, I think, and people would be calling, and this person says was looking at the dealer on the thing and saying chap. Chap means just print that price, because if it was 550 rupees, he wanted to see the price 560 on the screen. This guy had to keep on buying till it hit 560. He had to print the price on the screen. And the Chapo is actually because earlier you used to have a ticker that used to keep printing the prices. So people wanted to see the price printed on that sticker. So that's why you should say chap, because you print the price and until the price is printed, that is not the price. So they want the price to go up till there, right? So it could happen in a multiple ways. And, we've had a structural problem in the markets. And this is...
One question. How did this poor broker who was being given this directive, how did he offload that stock later in this case?
So somebody else is buying and he wants the price to go up to 560 and that person is willing to hold. The broker, of course, did not want to buy for his own account. He was buying on behalf of someone else. But that someone else is saying, listen, I don't mind you buying, but I want to see the price of 560 on screen. Now that could be somebody related to the promoter, somebody related to a market operator who simply wants to demonstrate. For instance, let me give you like the roughest example. Let's say I like to buy at all-time highs and 560 is the all-time high. You know that I'm going to buy at an all-time high, which means that, let me show him price 560, maybe he'll come and buy. So you take the price up to 560 to see if my algorithm kind of kicks in and says, boss, at 560, I'm buying a ton. So you bought all the way from 550 to 560. You can dump it to me at 561, 562 because I'm the one who's buying only when it goes past 560, right? So you could do this. And I'd say, well, you may have that inside information that I will buy at 560 and therefore you could buy. So this game rigging of some sorts or the other has been happening for a long time in the sense that if you had a lot of money and because moving a price from 550 to 560 takes money, there are a bunch of people who want to sell between that and they may not have as much money. They may be selling 1, 10, 15 shares and you're buying 1,000. So obviously you'll take the price up. So at some point, if you look at this particular problem that what Jane Street is.
I think when I cut you off, you were saying this has just exposed a structural problem in our markets.
Yeah, it is a structural problem in our markets because there are two big markets. One not as big as the other. And in the article I had mentioned that I'll talk about that. But there's a stock market where you buy and sell shares of companies. This market, and let me give you an example, and there are lots of reasons for this, including STT and income tax and all that. This market is really small compared to the options market, which is much larger. Just as an example for the days that SEBI has mentioned in this Jane Street order, they said, well, it's Jan 17th, 2024, which is about a year and a half back. Now, the day before, I just took the day before, Jan 16th, and I said, okay, let's look at the number of stocks that traded overall in the market. HDFC Bank, which is 25% of the Bank Nifty index, which is what Jane Street has been accused of manipulating. It is the largest stock in the Bank Nifty index and it was trading at maybe 1,500, maybe 2,000, 2,100 crores on that day, Jan 16th. Jan 17th is when options expire. So there are options on various things. There are options on stocks, there are options on future, options on indexes, options on, only stocks and indexes. But Bank Nifty is one of the indexes in which there are options of. We took the Bank Nifty index alone. That one traded 98 lakh crores of notional exposure. Now, we'll explain what options are and all that, but notional exposure is just the overall exposure. People pay a premium to buy options. You might say, listen, you can't look at the overall exposure. Let's look at the cash. Now, remember, HDFC Bank trades 2,000 crores. 98 lakh crores. Like a ridiculously higher multiple is what Bank Nifty options were. But if you took just the premium of the Bank Nifty options, which is a fraction of the total notional, even the premium of just Bank Nifty options, and not all Bank Nifty options, just Bank Nifty options that were maturing or expiring the next day itself, was 25,000 crores in premium. So, if you assume that HDFC Bank is 25% of Bank Nifty and its volume is 2,000 crores, you can roughly estimate that the index's volume is maybe 8,000 crores. But the premium on the options on Bank Nifty, just the premium, which is it's a small fraction of the total effective, exposure, is 25,000 crores or 3x. So it's like a ridiculously lopsided market. In my article, I said, basically you have options which are the size of Africa and the cash market to which the derivative is based, the options are based on, which is the size of a 3 BHK in Mumbai, which is 500 square feet, which would technically not even qualify as a 1 BHK in most places, but
It'll still cost 10 crores.
It'll
it's
still
fine,
cost 10 crores, yeah. But I mean, probably it costs as much as Africa sometimes. But the issue is that one of the complications over here is also taxation, because it's so screwed up in terms of the taxation specifics. Is that to trade an option, I have to pay a certain amount of tax called a securities transaction tax. I have to pay the security transaction tax, or STT, on stock as well. On stock, it is way more expensive than trading options, and futures come somewhere in the middle. And then we'll talk about this, but there's another thing called an index provider, which is NSE. They've created the index. They also trade. They also have the platform on which the index futures and options trade. They are perhaps have never tried to create a regulation on the size of the option market, although they have created a regulation on the size of the stocks markets. So the stock markets are limited to a certain percentage of the float that is available, a certain percentage of even futures are limited by, on stocks, on individual stocks are limited to a certain percentage of the free float, non-promoter holding of a company. But the bank nifty options have no limits at all. So we'll talk about all of these. I think the idea over here is there are a bunch of proposals that have been now, after the Jane Street investigation, have come through, which have been talked about, and we'll maybe go through some of them. But remember, this was a little bit of the Wild West in terms of allowing insane exposure on a derivative, way higher than anything we've seen in the real world. And to be fair, we've seen this once before in the subprime crisis, where people were betting on subprime derivatives, derivatives of subprime bonds. The derivative market of the subprime bonds was 100 times or 500 times the size of the subprime bond market itself. So if a bond defaulted, somebody had to pay 100 times the bond's effective face value, because a bunch of people were buying and selling insurance or derivatives on it. So it's a complex problem, but I think it's structural more than anything else.
Interesting example with the subprime crisis. I think the question that comes to mind to me is, look, in that 2008 financial crisis, the problem was because people started defaulting on mortgages which shouldn't have been like there in the first place, kind of, right? We get that. But over here, there has been no disastrous economic stock market fallout. So what went wrong per se? I mean, just because one market is perhaps unfortunately bigger than the other market because of friction, the derivatives market is bigger than the cash market because of frictions that exist in the cash market and so on. Okay, that is maybe it's undesirable, but what really went wrong?
Yeah, I think core to all of this is the fact that this was the tail wagging the dog, and in a way that the regulator didn't like it. In the sense, but to understand a little more, I think we have to understand what options are in the first place. So, we know about stocks, right? You buy a stock for 1,000 rupees, it goes up 10%, you make 100. If it goes down 10%, you lose 100. But let's say I'm greedy and I tell you, dude, I want to make the money if it goes up, but I don't want to lose money if it goes down. Can you create a contract like this which says, I'll buy something, give me the benefit if it goes up, but don't let me lose money on the way down. You say, well, fine, Deepak, here it is. It's called an option contract. We call it a call option. So you buy it at 1,000. If the stock goes above 1,000 on this particular date, which is called the expiry date, I will pay you whatever is above 1,000 as your profit. But if it goes down, you don't have to pay me anything. Don't worry about it. So I'm like, fantastic, this is great. Well, can I buy this contract? Well, yes, but I won't give it to you for free. I'll give it to you for a price. Now, what is that price? It's called a premium. Now, you will basically, how will you kind of say, what is the price of this option? Is it 10 rupees? Is it 20 rupees? Is it 50 rupees? There is a bunch of things that will go in, complex math. Your computer will go sizzle, burn, smoke comes out of the ears. And then you say, well, you know what? There is so many days left to the expiry. There is so much volatility in the market. The price could go up and down naturally because some fellow is buying and some fellow is selling. I want to account for that, and I want to charge you a premium that mostly says, listen, most likely I won't have to pay you. So what is the likelihood of that? Well, it will cost me 40 rupees. And this comes from the math thing. And you do this math and you say, well, 40 rupees, fantastic. I say, listen, 40 rupees is great. So if I've taken 1,000 rupee option from you, then it goes to 1,040. You'll pay me 40. I've already paid you 40. So it's break even. So I break even at 1,040. Below 1,000, I lose 40. But I'm fine because I'll never lose more than 40. That's the max I'll ever lose. If it goes to 1,200, you'll pay me 200. I would have paid you 40, net profit 160. I put in 40, I made a profit of 160, which is like fantastic, 400% return or profit or something like that, which is a disproportionate benefit, right? So I've only paid you 40. I've never paid you the 1,000. I've paid you just the premium, and whatever is greater will become my option thing. And as I get closer and closer to expiry, your 40 will come down naturally. There's two parts of this call option premium. One is you're thinking, well, you know what, Deepak, you want this option to at least pay out the interest rate. So because maybe you would have hedged by buying the stock. You put 1,000 rupees to buy the stock. Now there's an interest cost for that 1,000 rupees. That interest cost maybe, I don't know, for the whole month at 6% a year, 0.5%. The expiry is 1 month away. You're thinking, okay, boss, you're paying me 5 rupees out of this 40 only for the interest cost of the money that I have put in from now to expiry. That's called the carry, the interest rate differential. That is basically saying that you didn't have to put 1,000. I put the 1,000 instead. There you pay me the 5 rupees that I would have had to put. 6 rupees, 6% is low, but I'm just saying 6% is probably a risk-free rate in that sense. The same idea is applied then, saying, why are you paying the 35 rupees? Well, the stock is at 1,000. Your strike price is at 1,000. So you're going to pay me for 35 rupees. Now, if the stock was at 1,000 and you were doing a 900 option, it wouldn't be 140 because of the complex maths over here involved. It would be maybe 120. There's a reason for that, is because when it goes down, it has to go down below 900 for you to make a loss, or for me to make a loss as a buyer. So I get a little bit of a cushion in that 900 is in the money. The stock price is already greater than the strike price. If I bought 1,000 strike, so you have different strikes. You have an option at 900 strike, 1,000 strike, 1,100 strike, and so on. Now, 1,100 strike says, well, if it gets to 1,100, then I get paid. So you might charge me only 10 rupees for that option. So the price of the option depends on whether it's in the money or out of the money, the number of days left to expiry, the number of, the amount of volatility in the market. If this stock was going from 1,000 to 1,100 every day,
and then falling back,
then you'd be like, dude, this thing can cross 1,100 anytime. So I'm not going to charge you 10 rupees. I'll charge you 50 rupees for that option. So it's like this thing. So now think about this from a perspective of an individual who's doing these little bets. This little bet says, well, you know what? There's an expiry day. On that day, there is no cost to doing this trade. That trade could be, there's no cost of cash this 5 rupees that I talked about, that thing is not there. It's because
just one day.
Just one day. I'm starting in the morning, I'm ending. Now, the issue is, regardless of what you pay, your end of the day, you're getting settled out, right? So if the index goes up, you're making some money. If the index goes down, you're losing some money. This is a little bit of a gamble because you're only betting on one day. These are called zero DTE options in that sense, right? But why does anybody take the other side? You're buying the option. You have unlimited upside but limited downside. So why would anybody else take the option? Well, the answer to that is, there is a way to synthetically build something. Now, the seller is betting on the fact that, listen, you probably don't know how much it will go. So 1,000 rupees stock option, even on the expiry day, if I charge you 20 bucks, 20 rupees, that 20 rupees, requires the index to go up by 2% in the day. Maybe it won't go 2%. Most likely it won't. I'm willing to take that bet. So when I sell you the option, I'm taking the risk on the downside, but I don't get too much of an upside. But I'm happy because the upside comes to me and I feel I have more probability of getting the upside. Now, interestingly, if I sold a call option and bought a put option,
that's a shorter stock.
That's exactly the same payoff as a shorter stock, because if I bought a put option, I would get all the down. I would make money. A put option is just the opposite of a call option, where you get paid if the stock goes down. So if I bought a put option at 1,000, that means anything below 1,000 I get paid. I get a profit, right? But if the stock went above 1,000, the put option would not lose any money. But if I sold a call option, I would lose money. So essentially, if I make money when the stock goes down, but I lose money when the stock goes up, this is equivalent to shorting a stock or going short a stock or short selling a stock in that sense. So you have effectively sold a future. Now there is an underlying stock. If the stock trades at 1,000, Now, I do this sell call and a buy put. Sell a call, I may be charging 40 rupees. To buy a put, I may be paying only 20 rupees. So the net difference between the two is 20 rupees. So effectively, I have sold the future at 1020. This is 2% higher than the stock itself. So now I could buy the stock and do this sell call buy put combination and lock in this 20 rupee difference
In one day.
In one day, which is 2% in a day, which is fantastic. I would do this, any day. I'd love to do it. But because these bids and asks come very fast, I need to do it using a computer or an algorithm. Earlier, people used to do it manually. Now they do it using computers, which is all fair. Now, what's happened is this is called arbitrage. And this is perfectly fair. I was in a past life doing the same thing in 2009, 2010 or whatever it was at that time. But I don't think this has no problem at all. Now, why would these prices be wonky? The prices would be wonky mostly because this is the retail trader whose idea is this is my dream 11 in the stock market, which is I am going in. I'm taking this bet on this one day. He's charging me 40 rupees for a day. I don't care. If the stock goes up by 40 rupees, I will just make money. If it goes down, I lose my 40. It's okay. And 40 rupees, and there's a lot size in many of these things. The lot size could be 25 or 10, or I think it was 25 for Bank Nifty at the time. And you could say, oh, well, 25 is 25. Let's see what happens now. 25 into 40 is about 1,000 rupees. So I'll say I put 1,000 rupees. Worst case, I lose 1,000. Best case, I make 5,000. I'm okay with doing that. So they pay obscenely high premiums for stock options.
Because in a sense, they're almost playing a different role here. This is almost like gambling money, or let's see if we can get lucky money, rather than let's plug this into some of those Black-Scholes calculators and see what is the right price or whatever the case may be.
So, and on the other side was somebody like Jane Street saying, listen, we'll have this algorithm that says we'll detect when these prices go bonkers. And what they would do is actually because only Bank Nifty options were expiring weekly at the time. These weekly options are on the Bank Nifty index. The Bank Nifty index consists of only 12 stocks, out of which 25% is HDFC Bank and 25% is now ICICI Bank and all that. But if you consider the fact that you had to buy 12 stocks to make up the index is made up of these component stocks. You just have to buy them in the same proportion. You bought 12 stocks to buy the index. And you sold these options and you covered the difference. And in Jane Street's case, the difference was as much as 1.6 or 1.8% in the beginning of the day for one day. And then it narrowed down within 5 or 6 minutes to 11 rupees, which is on a 47,000 index, nothing, point something percent. So it's gone from 1.6% to 0. So they actually bridged that arbitrage and brought it down.
So, Deepak, this is God's work, na? A hard-working hedge fund comes in with its fancy computer models, big amounts of liquidity, takes an inefficient market and makes things priced correctly. So, why are you taking their case?
This is a good point. SEBI actually gives us the numbers. In the numbers, it turns out that doing God's work would have been to buy one thing and sell the exact same quantity of the same thing on the options market. But if you bought 1 rupee on the stock market and sold 7 rupees in the options market, suddenly people start thinking, hello, are you really doing arbitrage? And there's a reason for that. I'll come to it. They bought a truckload of positions in stocks. That was maybe 500 crores in the first 5 minutes. They sold options worth 8,000 crores.
It's a little higher.
A little bit higher, you think. And these are worth in the sense, these are not like premium worth 8,000 crores or something like that. It's just delta exposure, which means that when you say a delta, it means, if I'm selling an at the money option, and if I'm selling it at 1,000 rupees, I will actually take it to be worth 500 rupees. The delta is 0.5, right? So I multiply the stock by 0.5 because the delta works that way. The delta of 8,000 crores was a delta based on which strike option you sold and all that stuff. But they still had 8,000 crores of delta exposure, which is literally like saying I took a 15x position on the short side and 1x position on the long side, and I'm calling it arbitrage. You'll be like, dude, 1,000 I can understand, 1x I can understand, 2x I can understand because your delta is 0.5 in general. But 7x is weird because it was the expiry day. And towards the end of the day, you would have thought they would cover both sides, right? You went long one and short the other. You would go short one, cover one or rather sell one and cover the other. The answer was no. They just sold just the bank nifty stocks, and they had gone from 500 crores to like 5,000 crores in the cash market, and from 8,000 crores to some 42,000 crores or something in the option market. So they dumped the stocks. They got rid of a few of the futures. They still ended up with 24,000 crores of open short positions. Now, when you dump stocks worth 5,000 crores, remember I told you HDFC Bank trades only about 2,000 crores in the whole day. When you dump 5,000 crores in the last 1 hour of the market of the Bank Nifty Index stocks, you're going to dump the price. And when the price went down, their options which expired got marked to the lower price of the stocks, because that's how expiry day works. You expire at and settle at the price of the stocks. And settle for cash. And you got this massive payoff. And apparently they made some 700 crores in options. But in the process of buying and selling the cash future, they lost a relatively small 60 crores.
So you lose 60 crores in the stock is what you're saying, but you make 700 crores in the options. So yeah, hence it's not really a hedge. But yeah, so that does seem that you're only able to change the price of the underlying by virtue of like selling it fairly rapidly.
Very rapidly, yes.
And in size. And you have something exposed to that, I guess with leverage is the right way to put it. So when you have bets on both sides and you make one side fall by X and you make 10X maybe the other side. I think, so that's the core of SEBI's contention.
And then there's the layer of, you use multiple entities for
why
this.
is that a problem? I mean, this is done for some tax efficiency reason, right?
Yeah, so it's interesting. It's a combination of regulation, taxation, limits, transaction limits and so on. But let's admit to the fact that, okay, there's somebody who's buying stocks and selling stocks and somebody who's buying futures and selling futures. They're two different entities. SEBI said, listen, you both are the same entity. One entity was a foreign portfolio investor, which was doing the options trades.
Makes sense.
And the cash trades were mostly likely focused on the Indian entity, which Jane Street had a subsidiary in India, which was doing this. So you'd think, well, you know what? Why are you doing this, buying and selling stocks in one entity and making all the profits and options in another entity? Is the Indian entity dumping the stocks just so that the foreign entity can make money? The answer is, even if it was a concerted strategy across the two, I would say that the reason why this happened was probably because of rules. For instance, if I buy stocks in the morning and sell in the evening, and FII is not allowed to do that. We as a PMS also not allowed to do that. We as a mutual fund are also not allowed to do that. We cannot buy in the morning and sell in the evening the same stock. However, a foreign portfolio investor can't do that, but they can buy and sell options on the same day. That's perfectly legal. The Indian entity has to pay, because it's an Indian corporate entity, it is allowed to do intraday trading. So the stocks had to be bought in the Indian entity and sold in the Indian entity. The foreign portfolio investor, why didn't they do options also in the Indian entity? Is because there are taxation differences. The foreign portfolio investor gets a discounted tax rate because of one rule in 2019 which classified their entire derivatives, futures and options transactions as capital gains. For a domestic Indian investor, futures and options trades are called business income. Business income for a company will be taxed at 25+% or this thing, and for an individual is taxed at 40%, 39%. But even 25% is high, but for a short-term capital gain for a foreign portfolio investor, the taxation is only 20%. So you have a lower taxation if you do the options trades with the foreign portfolio investor, and a regulatory allowance to do intraday trades for the domestic investor. So there are two different investors. Now, the idea is you started off arbitraging, but in the end of the day, you dumped the stocks from the Indian entity and benefited hugely in the foreign entity. The short position much larger than the long position. So all the profits went to the tax protected or lower tax enabled foreign entity, which has therefore kind of reaped the benefit of it all.
So I'm going to now try and jump to a conclusion, which is the question I'm asking is, so isn't this then an open and shut case? You've sort of shown ki arbitrage, this is going to be hard to justify. Like how, I mean, I guess you'll try to say ki some way this was delta neutral, or you'll add some other Greeks and say when I balance across these Greeks, both of these strategies were in sync with each other or something. But the fact of the matter is that you had a disproportionate exposure on one side, less on the other, and you deliberately took losses on one to help your more disproportionate side do well. So that's the first. And the second point that actually comes to mind is that SEBI doesn't like it when you have two different entities acting in concert when they're, legally different entities, because there are some position limits or something, right? I mean, along those lines. But I remember reading the order and they were just not happy with one entity doing it. It sort of violates the entity principle or something. But here's my question. So, case over, na? Why is there even a discussion?
Oh yeah, I mean, to be fair, people have been doing this for a while, but this marking the close, which is essentially dumping stocks to get lower price so that you can settle at those prices, are particularly egregious, and it is not really high frequency in that sense. There were a bunch of scandals. LIBOR was a scandal like this. Now, LIBOR, what is the mark? The mark was the daily LIBOR interbank rate. So apparently there were a bunch of banks that used to do interbank trades in the past. Now that rate was called LIBOR, LIBOR, which is London Interbank Offer Rate. And the LIBOR was done on USD, Euro dollar transactions, on dollar transactions. People put a bunch of contracts that were linked to LIBOR.
It was the basis of almost everything, right?
Yeah, a lot of stuff. Except banks weren't borrowing from each other anymore. They were borrowing from different markets, but they were essentially quoting this LIBOR rate. The LIBOR rate, I mean, it has a rate that is done like this. You call up a bank and you say, well, what's your LIBOR rate today? Well, you say, I can offer at 5.25, I'll buy at 5.15%. That's the rate that you think is right. And then what they do is they poll all the banks and then they come out with a final number that is X. Now, if this bank doesn't really have to borrow from each other, and in actual differentiation between the two, that's LIBOR versus, one bank versus the other, they all have derivative positions which are based on the contracts that these are linked to LIBOR, right? So if the LIBOR is higher, maybe I stand to benefit. So I call up another bank and say, listen, buddy, I need to get the LIBOR at 5.25 today. So please quote high. So they would collude with each other to increase the rate on some days and decrease the rate on other days, as long as it benefited them. It probably gypped their customers. But more and more people started looking at LIBOR as, this is just a scandal. This is just bullshit. We shouldn't be linking anything to LIBOR. India had rules, or perhaps even now does, which allows a corporate in India to only take a loan which is 3 basis points above LIBOR max. So you can't have a loan that's more than 300 basis points above LIBOR. Yeah. So if LIBOR is 2.5, you can take a loan up to 5.5. But if LIBOR itself is manipulated and wrong, then I could call up a bank and say, boss, make it 3%. No, because I want to borrow at 6%. I can't borrow at more than 3% above. And the bank is like, fine, sure. I'm the one who's lending it to you at 6%. So I'm happy to kind of push the LIBOR rate up. So you would actually change the LIBOR rate. And when they found this out, they were furious, except no bank got in trouble for this. Meaningfully, there was some this thing and all that. There was another case which was in India, which was in 2007, I think, in November 2007, where one of India's largest company called Reliance Industries had a subsidiary called RPL, Reliance Petroleum, which they own 90% of. And they needed to sell 5% of this company for meeting their corporate purposes. And they knew that when you sell 5% of a company where only 10% of free float exists outside, you're going to tank the stock. So the price was 294. They said, well, you know what? We're going to sell this. So they called up a bunch of brokers and said, please take shorts futures position to protect our price when we're selling it. Because when we sell it, the price is going to come down. But we'll benefit from the short futures position. So they said, okay, well, that's fine. And then they had about 22 crore shares to sell. They took short positions through the brokers of only 10 crore shares. That was not, because there are stock limits, and those limits don't allow you to go to more than X%, and that X% was maybe 10 crores shares at the time. So they had 22 crores to sell. In the course of the entire month, from November 1st to November 29th, they sold nearly 20 crores of shares, and they covered a bunch of those futures, but they left. See, when you start off with 10 crore shares, and you have 22 crore shares to sell. You'll be making more losses on the shares you sell because the price has come down. It fell down to 224 or something before the last day, and they were like, okay, well, it's fallen to 224. I've lost on 20 crore shares, but I have gained only on 10 crore shares because I was short only 10 crore. So what they did was they didn't cover the entire position. They covered only two. So they had an open position, short position of about 7 crore shares on the last day of expiry. And in the last 10 minutes or so of expiry, they dumped another 2 crore shares. Now, 2 crore shares are not much, but still at 224 rupees per share, that's 500 crores for 2007. It's a huge amount of money. So the price fell by like 10 or 15 rupees at the time. SEBI took offense to this, saying, listen, you brought the price down from 224 to 209 or something. And you benefited from it because you had 7 crores worth of short positions. So you sold 2 crore shares, you had 7 crores of short positions. Bad boy. I would say this is going through the entire case by itself. It does not look too unfair to have taken a position that says I need to sell 5 crore shares. I'm protecting myself by buying a hedge. I have hedged only half my position for most of the month, except for the last day when I had a slightly higher hedge. But net, if you look at the whole month, I'm still okay. But SEBI fined them 440 crores, 7 crores, something like that. It was appealed. SAT upheld the fine. They removed some other stuff, but they upheld the fine. The case is now in Supreme Court. Supreme Court has said, listen, you need to deposit 250 crores in escrow while we decide this case. The case is still on. They have deposited 250 crores. But there have been two levels of holding a fine down. So they've held the fine at 250 crores by SEBI's order. SAT has at 447 crores by SEBI, and then 447 crores was upheld by this. This was, while it sounds like an open and shut. This particular case sounds way more open and shut because you're like 7x the volumes, and you've done it in a market that has almost unlimited volume. But the big problem here, there it was roughly 1:1 if you consider the net impact of the whole month. Here it is on one day, 7x. I think SEBI has a solid case here, if you ask me.
Okay. I'm going to challenge you a bit for the sake of challenging you, even though, but I will share the two examples you just gave me now about LIBOR and this Reliance example. I feel something is different there. I'm building towards my argument. I feel something is different there because in LIBOR, because of historical practice, you've kind of given banks this authority to set this rate, and they're abusing it by some sort of almost price fixing, like calling my friend saying, please ye bol do, and then I'll lend against it. So I can get the outrage there. And I do think people have been hurt on this. I don't know if folks were fired. I'm sure some were, but there were fairly large fines. Barclays and all, they did pay fines, I think. I know books have been written about this, certainly. I never read all of them, so I don't know. But that's one. And on Reliance also, I completely sympathize that this was a bona fide transaction in their mind and they had not realized like whatever the impact it might happen on people. But SEBI is like, as the person who owns this almost like promoters type stake in this company, you, because of your whatever insider knowledge and goals, ended up temporarily hurting the price, and there are people who have been hurt by your actions, and you were in a special status by virtue of the amount you held. Okay, so that's my intuitions on both of these, and why SEBI was justified in being, whoever the UK regulator was, I forgot their name, being upset with the UK people and the banks, and SEBI being upset for Reliance. But here, when it comes to Jane Street, they don't have any privileged position. They just have to jump through the same hoops as any other hedge fund who has to come to India. So all they had is money. So that should be like, aren't there things like position limits and all that are supposed to protect people against like someone with large money coming in? Anyone else could have also come in. Why didn't anyone take the other side?
Yeah, to be fair, I wish the Reliance, one of the things in that Reliance case was that they violated position limits by taking the 10 crore position across some 10 brokers. They said, if it was all Reliance, then you would have been restricted to 1 crore, which was the position limit for the stock on a single contract. So they were this thing. But guess what doesn't have position limits? Bank Nifty options. You don't have any limit to what any human person can do. And specifically, there's no limit on it intraday. So I could be 99% of the market intraday and it would all be fine. So this was a issue, and honestly, you're right, but because markets do try to protect against these large players coming and managing it by saying any one player in the stock futures market cannot hold more than 1% of positions in a derivative stock. So it's 10% overall added up in derivatives, or 10% of that 10% is one person's limit. So essentially, you could not have more than 1% in the stock market of any stock. So the same HDFC Bank, take 1% of its free float, and you could not have more than 1% of the free float of HDFC Bank held by any one entity at the end of a trading day in a stock, and in the options of HDFC Bank. But remember, nobody traded the options of HDFC Bank, traded the cash of HDFC Bank and bought and sold the options of the Bank Nifty. And the Bank Nifty as an index has no limits at all, which is why you can go to 98 lakh crores notional when the index itself trades like 8,000-9,000 crores a day. So it's one ridiculous thing that has happened where there are no trading limits and there are no intraday trading limits at all on a per person basis. This is equivalent to going to a poker game where there are no limits, where you may go in with $500 and somebody comes in with $10 million. They can kill you every day because they can keep going all in. And if you have the best hand, you'll probably say, okay, I'll stay. But anything less than the best hand, you're losing whatever money you've bet on the table so far. And you have to bet like 10% of the pool. So what they do is they create tables and say max bet is $100, max bet is $200. That means the most rich person can only bet $200 even if they go all in or if they go all in, but if they want to buy into the table. So at max, if there are 5 players, 200 into 5,000 is the size of the pool, and you can never go beyond $1,000 in overall size, right? So you end up with this size limitation by nature by saying there's a max buy-in on the game. The new set of rules that have come in a certain way still don't address this problem meaningfully. There was a rule that came in on May 26th, and it's important to understand May 26, 2025.
Oh, so that's like just 6 weeks ago or something, yeah.
Which suddenly came and said, listen, on Bank Nifty options, we will look at the positions and say no one person can own more than 15% of the market. But this is at the end of the day. The problem that has happened has not happened at the end of the day. The problem that has happened intraday. It started in the morning. It was completely squared off by evening. And the expiry day end, it doesn't matter how many positions you have open left at the end of the day. They are considered settled at 3:30 p.m. That means you have no open positions at the end of the day according to SEBI. So these position limits, while they have been created, does not limit the size of the market. The size of the market can still go. There's no market-wide position limit, and there is no, situations at all. And I think one of the problems really is that you don't have a lot of other participation that can actually come and change this. Because the cash market is so small that it can be manipulated. It's the basis on which the derivative market trades, and the derivative market is absolutely massive with no limits. So while there are position limits on some parts of the market, there are no position limits on this part of the market, and that's where I think you have a problem.
Let me step in and I'll ask one of them again in a different way, but. The first thing was this just an oversight? Like, why didn't they have intraday position limits on this? That's the first question that comes to mind. Because we operate in the cash segment. In our PMS and our RA and all that stuff, and we're very heavily regulated. It takes quite a bit of effort to do anything. And so, why was this place allowed to be a bit like the Wild West? Is this a SEBI decision, an NSE decision, or BSE decision? I think that's. Let me just do that question
I think
first.
In 2016 or so, when things were different, we had a layer of trading that happened on the month-end futures and options. This is also a fairly big market, but month-end futures and options always. What happens in month-end futures is stock futures mature, stock options mature, index futures mature, index options mature. Everything matures on the same day. So you could have all of this. But these weekly things came from some US thing which started weeklies. But in the US, weekly stock options trade a lot. And weekly stock options always expire into the stock itself. That means if you buy a call option, you receive the stock in your bank account, in your demat account or whatever that is, your brokerage account. And if you sell a put or sell a call, you are supposed to give someone so many stocks. So you are actually going to have to give someone those shares and buy them and deliver them to those stock exchanges. So it's settled by delivery. Bank or Nifty options, although, are settled by cash, and they're very, very large, right? So at one layer, these position limits that should have existed in the fact that you didn't ever have to settle using stock or anything like that. You could have changed those rules, and we'll come to that at a later point. But I think the problem is that these limits were never set for index options, and they kept growing bigger and bigger. And weekly, there are only options. There's no weekly future. There's no weekly stock future. There was only weekly index options, and that too of Bank Nifty on Tuesdays, Nifty on Thursdays. There was some mid cap 150, which was another day, and something else, which was another day. So basically, they had one thing you could play for on the beginning of every single day of the week.
So there should be no empty day, basically.
There should be, basically, you're playing. I have the casino ready for you, and the difference perhaps in the casino versus this, and we'll come to that, is perhaps in the casino you know who the house is. Here, you could be the house yourself if you're selling those options. Except Jane Street, with its far bigger cash market, suddenly became the house. So that was, I think, a trigger problem for SEBI to say, well, you can't be the big player here.
No, I think I get it. I mean, I guess at some level the thinking was that there's no point regulating this market because this is healthier gambling than, say, any other type of gambling that exists. But I mean, clearly that has not worked out. And SEBI keeps publishing the papers pointing out that 90 or 93% of people lose money, and it doesn't seem to bother them at all. Two things that come to mind as you're saying this is, look, is Jane Street's problem just that they were so big? Like, I keep feeling, given that you've talked to this, stuff like this must be happening all the time, right? Anyway, so that's my first question. And the second question was, okay, let's do this one.
Let's do this first. Yeah. I think, so has it happened before? I can give you many examples. There are times in which we've seen stocks manipulated much after the fact, and sometimes it's not even detectable. I'll give you an example. There's a company called Amtech India, and its stock was trading at 30 rupees. They had done a huge foreign currency convertible bond issue, which miraculously had a concept that said, well, I've given you a loan, I will convert it to shares if the stock price is 190 rupees. Or 195 rupees or something like that. But if it's less than 195, I can choose not to convert it into shares, and I can just ask you to return the money. Now, this company, if it had to return the money, it would have gone into the dole. It would have gone to zero at that time because it didn't have the money to pay. So people are wondering what will happen. But suddenly, the stock starts moving up. There are no news. The stock's hitting upper circuits every day. 30 becomes 33, 33 becomes 36. So it keeps going up, and people are wondering what is happening. The stock operates on circuits. That's, by the way, another limit, that a stock can't move more than 10% or 20%, and it comes down to as much as 5% after 2 or 3 days. But even if when it was going up, it was going up on circuits. It went all the way from 30 to 360. This 190 price I'm talking about was supposed to be the weighted average, or the average price of 6 months. In the 6 months or 3 months, whatever that period was, the average price, as the price went from 30 to 300, was very coincidentally 194 or something. Just
quite
above.
A coincidence.
Yes, and just above the price it needed to be for them to be forced to convert into shares. So the FI has now said, well, you can't ask for our money back, we're going to convert to shares, so they're going to start dumping it. They started taking the shares and dumping them, and then, you know what, the stock fell from 350 down to 30 and eventually went to zero and all that. But the point over here is, was this natural for the stock to have gone from 30 to 350 just so that the average price of that 6 months was just above the value at which they didn't have to pay back money and they had to do this? The answer is, well, we don't know. It sounds like quite a fortunate event for the stock to have just gone exactly to that point and then seen that dumping happen that brings it back all the way down. You could say that it is providence, but also you could say that, well, maybe somebody did it. And we don't know who that somebody is because SEBI tried to investigate. They could find nothing. So whoever did it covered their tracks very well. Maybe Jane Street didn't. Maybe Jane Street tried. They had 4 entities and all that. Maybe they needed 500 entities and nobody would have figured it out. But, there are things like this that happen all the time. And sometimes even if you look deeper and you don't go into as much detail as perhaps you would require to get it, because many of these things will happen through brokers who seem to be completely unrelated to each other, but miraculously this stuff is happening in the background. And SEBI does find sometimes that there's some linkages, like if there was a bunch of brokers recently that got dinged for front running their clients. The people who are front running the clients were working for the brokerage, but also owned stakes in certain companies, which somehow benefited from the same stocks which their larger FII clients were selling or buying at the same time. So SEBI said, well, you own those stocks. So these are related parties. You own those companies. So how come they've made so many profits in exactly those same stocks? But if they weren't related to those companies, SEBI would have had a difficult time making the connection. And they might have said, listen, we can't make a connection, so we'll have to let you go. So maybe it's that, that letting you, this thing is different. Yeah.
I remembered my other question. It's something you just mentioned in passing a little previously, is that the cash market is just too small. And in the beginning, you've talked about there's this STT, which is irritating. Then there's all these various position size limits. But why is the cash market so small? I remember reading a tweet by Nitin of Zerodha also, when he said it's because it's only one directional or something. But could you just talk through why is the cash market so small, and why were our domestic institutions who are reasonably well off and well capitalized not rushing in to take the other side of Jane Street?
This is a great point, because why isn't there any domestic competition? I'll tell you this. There's a bunch of, like I told you already, there is a problem if a domestic company does the futures trade. To beat them in the futures game, they were at 24,000 crores. I should have put in 24,000 crores worth of other side delta. But remember, Jane Street had 15,000 crores just in government securities to provide as margin. Now, not many players exist that have that kind of capital, and perhaps they're small today and they're growing up. But to a certain extent, what happened was a result of the fact that domestic players pay a lot more in terms of STT, transaction costs, and taxes. So, for instance, you have a higher taxation for domestic players. If I am a domestic player, I might get charged 25%, I might get charged 39%, depending on whether I'm a prop book or a trust or a private limited company. The FII player pays only 20% tax, so he has more incentive to do it. The second layer is STT. On 1,000 rupees worth of a stock, I will pay 0.1%, which is roughly 1 rupee on each side, buy and sell. So if I want to buy a stock and sell a stock, I'll pay 0.1%. If I do it intraday, I'll pay 0.01%. But if you pay 40 rupees as premium, you pay 0.1% or something like that of the option premium itself, or some small percentage of the option premium. I pay 2 rupees to trade 1,000 rupees stock in and out on multiple days. But if I do it on the same day, I pay 20 paisa. The option buyer pays like a fraction of a paisa or something like that. So essentially, you've created a situation where intraday trading is considered cheap, is given a cheaper transaction cost. Options are given an even more cheap transaction cost. So you're effectively incentivizing people to trade options. So it's like both income tax and STT is like, you should do the other thing.
Yeah. No, that's a very, but this feels it has to be an unintended consequence, right? To allow foreign investors to make all their money through trading intraday options. Anyway, fine. It is what it is.
It is what it is. Yes.
I was going to come to retail. Like, even if you forced and sat down 1,000 retail people and said, you have to listen to this podcast episode and read this SEBI paper, then after one day of enduring the torture that all listening to this in great detail is, they will still, however, go back and continue to trade options unhindered, right? I guess what my point is, the retail is unfazed by Jane Street's actions. Would you agree with this?
I agree with this from a different perspective, and this is more, I guess, philosophical now than it is rational. I keep thinking, why does this guy, I met a CRPF Jawan at one point who told me that while he was detecting bad things in your luggage at the airport, he also had a stuck bank nifty position. So I was like, dude, how do you get time to trade this stuff? And why are you trading this stuff? You're in a place where people could have really bad things in their luggage, and your bank nifty position will go to hell and come back before you finish your assessment. So I realize that we're in a position of privilege because we've somehow been able to kind of make it through the vagaries of life. And a lot of people live very difficult lives in the sense of you're living in a job where your income growth is possibly not much. Think of the watchman, the CRPF Jawan, or whatever it is. Their chances of getting increments in their income are very very low.
Modest.
They have loans because they've had to, maybe a medical challenge here and there, a baby, this, that, all that stuff. So they're living in a very very restricted environment with no real chance, and possibly a chance of losing their job as well because they screw it up. For them, the hope that comes is that lottery ticket they buy every day. And people do sometimes often just go and buy a lottery ticket every day because they gives them a little bit of hope, that they cling on to that. It's not for me to tell them you shouldn't buy a lottery ticket because your chances of success are so low. But for him, it's like, listen, it's 500 rupees a day. It gives me a chance at making 5,000. 5,000 will actually change my life for that day or for that month, right? So maybe that's what I need to get out of this mess. I just need a break. And nobody's giving me one, so I'm going to have to make my own. They would earlier buy lottery tickets, they got banned. They could do betting on horse races, that is limited. This is their way out. It's an app that works. It's sitting out there. It gives them the ability to do this. And I don't think it's in this thing to say that they shouldn't be doing it. And this 90% number, as we've talked in another thing, it's not necessarily a bad thing because it's a skill and people learn over time. Even an exam of an IIT exam will have only a 1% success rate. But that doesn't mean that people who are out there do the exam are all dumb people. It's just that they learn. Perhaps if you give this exam 2 or 3 times, there is a greater chance of the pool of people that have given it 3 times. I don't think 99% fail. So it might be only 95%. So more people succeed if they give the exam multiple times. It takes a lot of failures for a success to happen. So at some level that is another part. But I feel over here the problem really is that we've given people hope in the form of making these micro bets. But we've also got to ensure a fair environment, saying, listen, nobody's jipping you on this stuff. You're playing the fair game. And that's why even gambling places are not allowed to, kind of rig the game out against.
Beyond the point.
So it's like you can only have a 51% odds in your case. That means you can't have a 75 or 80%. That means I can't rig it and say, listen, in this deck of cards, you can bet on the ace of spades, but I conveniently remove the ace of spades and I give you and show you only 51 cards. You can never win. And if you can never win, it's never fair in your side. So the gambling association or whatever will make some rules saying, listen, we can't have all this stuff happening. I'm sure it does happen. There are lots of dabba trades that people, use to con people. But I think at some level, the regulatory element has to come and say it's fair. Now, usually it is, because the options is a fair game that you can play both on the selling side and on the buying side. So you and I, with a lot of money, can go in and say, we'll take the other side of this trade. So that person who wants to come and gamble, let him come and gamble. I will make a little bit of money every day. And one day when he has to be paid out, I'll pay him a little more money. But net, I'll still make money. And for him, it's a gamble. For me, it's a way to earn an income because I'm doing it systematically. But they don't expect that one person, Jane Street, will come and be on the other side and basically take over the entire part of this part of the universe. Not that this is necessarily bad, but in general, it invites regulatory attention, because at some point, if somebody says, well, he made 42,000 crores last year from trading options, the regulator is like, hello, are you doing something that is somehow moving the market in your direction? Are you hiding that ace of spades? And then, are showing the world a game that is rigged? That is, I think, the problem. And, indices are to a certain extent gameable. We know this.
I really wanted to ask about this. So just the question on this is, why were the indices allowed to go unregulated for so long? Should we regulate them now to hell and back, or should you just create more competition? I guess that will have its own limitations because then you have to like create options on each one of them or whatever. But how would you go about that?
Yeah, I mean, to be fair, we've seen SEBI go after RAs and IAs and all that stuff who said invest in this, invest in that, invest in this portfolio and all that stuff.
I've given so much returns in the past.
Even if they have,
they're not allowed to say that.
They're not allowed to say that anymore. So when we've done that, we've not really concentrated on the fact that the indexes themselves, although they're handled by the NSE and the BSE and all that stuff, and S&P and CRISIL and all these guys, but these guys are effectively beneficiaries, especially the exchanges. They're beneficiaries of the derivatives that happen on these indexes. So they are also the creators of these indexes. So if they create an index with only 12 constituents, that's their bad. And nobody saw this all the way till 2024 when there was a consultation paper which has not yet come into effect that said, well, maybe we should regulate the indexes a little more. This not happened for the longest time, and perhaps it should have happened earlier. But more importantly, what's happened is that we still don't, we have the guy who's the regulator of the exchange, regulator, which is the exchange itself, creating an index, which is the product, which benefits another product, which is the derivative, which it only makes profit from. So it makes profit from the indexes, it makes profit from the derivatives that are run on the index, and it is somehow supposed to regulate this whole thing while it makes so much profit from it. The chances are it's very low. And guess what? If you want to create a competitive index, you can't. Because their agreements say that, listen, the closing prices are copyright. We can't give it to you. And because it's based on a price, on a perhaps an old court case in which I think it was the NYSE that sued someone saying you can't use my closing prices because the closing prices are on my exchange, so therefore I own it. So they were able to copyright a number somehow. And because of that, I think NSE and BSE say, well, you can't use it. But the new rules which are given, it's a consultancy paper, it's not yet final, force the exchanges to give the closing prices without any licensing fee to a person who wants to create an index if they come under the SEBI regulated index manufacturing space. I think in a way this is proxy fund management. If the index, if there is an index guy and there's so many ETFs running on it, so many index funds running on it, so many derivatives running on it, but if you are the venue, the manufacturer and the regulator, and I disallow other people from getting any data, what's the point of competition? You'd never have one. In India, you do have that problem, and I think this is a worldwide problem as well. But the idea is, over a long period of time, the indexes and the manufacturers of the index and all that stuff should have made the markets more efficient. However, they focused on making the market more liquid. Liquidity, as we have seen, is not really equal to efficiency, because unless you have a diverse set of players that can play all of the markets, you will have problems. And you can't have one market which is 500x the size of another market, and that one market is now related to the other market in some way. There should have been some layer of regulatory control over any of these things. And you can see this now. For instance, the same product called an ETF. You would have thought that, listen, you created an index, you created an ETF. So obviously there should be trading that's happening in that ETF. More or less, yes. But we've seen this in the past, and we've seen that prices of an ETF can vary substantially from the underlying NAV of the ETF itself, which means the markets were not efficient, and that liquidity concern that is there has had to be bridged over a long period of time. Even today at 9:15 a.m., the same period in which SEBI has said that prices were all this. At the same time, if you look at an ETF that traded the bank nifty, that ETF price would be all wonky, all over the place, because some people come overnight, they place orders, and it gets executed at 9:15 automatically because brokers dump whatever overnight orders were there at 9:15, and whatever price was there, if it was 5% above the underlying bank nifty value, you would still get executed. So if I was a poor guy who decided that I'd put an overnight order, I might get 5% higher than the bank nifty, and there is no meaningful way to protect against that. So I think exchanges might have had another way to handle ETF market making, so that it is more relevant and less hurtful to the investor, but they chose not to do that. Instead, they built liquidity in the derivatives market instead. So
made it more exciting.
more exciting. Yeah.
On that, by the way, I just wanted to say that it's always occurred to me that I remember back in the day, people would say, "Look, it's supposed to be this index published by, I don't know, one of the exchanges, and it has an error." And then you email them, and then the error vanishes. They never acknowledge it or whatever. So you're like, and the reason kind of this matters is there's now a bunch of. Remember when we started Momentum, it was like this, like whatever, back in 2019 or whenever you started in the PMS, it was this somewhat well understood, but by some people in the industry thing. Now there are index funds on it. So the guy manufacturing the index is essentially a fund manager at some level. I mean, a proxy fund manager, or in effect, a fund manager. Would you agree? I mean,
so in that sense, yes, because if you publish some rules saying, listen, the stocks that should be selected as part of this index should exactly be A, B, and C based on these rules. That means if I reach a point where the index has to be changed, the index is changed every 6 months, then I know that A, B, and C qualify. That means A, B, and C are coming in. The answer is no. Somebody sits there and says, oh, well, you know what? A and B are coming in, C is not coming in. How are you making these decisions subjectively when your index was supposed to be objective and based on a set of rules? And there's another way to look at it. If it was objective, then anybody in the market could say, listen, A and B and C are coming into the index for regardless of whatever we do. So let's buy up A and B and C from the stock market in advance, and all these stupid ETFs will have to chase A, B and C after it is added to the index, which is the end of the month, and I will make a truckload of money by selling it to them because they have to buy it. And this is not privileged information anymore because everybody knows the index is going to change to A, B and C at the end of the month. So in a sense, now the guy who's manufacturing the index doesn't have to look at the stocks that make up the index. He also has to look at, oh my God, can somebody jip these indexes by, kind of front running them? Maybe I should not select all the stocks I should. Or, I don't know what kind of goes into the decision making criteria, why something goes in or why something does not. But we sure as hell aren't told why. And in the end, it becomes a quasi-fund manager who is not even regulated like fund managers are otherwise, who would have to put rationales on why they should select their stocks. They should have a written rationale before they buy. They should have a written rationale before they sell. The index manufacturers can say, I got up in the morning, I don't like stocks starting with the letter L, so I'm not going to add it to the index today. So you have no recourse against this stuff. Zero. There is no regulatory reason why they don't even have to explain why. They literally say, well, you know what, we sat together, we thought about it, and we did inky pinky ponky.
I mean, they can, and basically as long as you don't have much grounds to question them. I mean, yes. and they're not obliged to answer. So it is unfortunately a black box on which many thousands of crores are being traded, and that does feel like it's an area we need to look into. And I would agree. I'll end with this thing. Look, earlier this week, Jane Street made a deposit, right, of some several thousand crores and said, hey, we've done nothing wrong. I read their op-eds. They pointed out that it's a market that we followed the rules. Yeah, fine, maybe we made a mistake here or there, but the fact is that it's not our fault that you had a market that was designed this way. That's your fault. I came in and took advantage of it, and to the extent I have broken any rules on like entities and all, sure, yes, you're right, I'll pay the fine on that, but this was your mistake, not mine. I'm not here to ask you to defend or to counter that. Here's what my question is. Is there really a villain in this story, or is there any lesson really to be learned? Or every time something goes wrong, we just have to make our market stronger, change some regulations and move on from there? And by the way, on the regulations, things like taxes and all, SEBI doesn't get to decide, right? I mean, that's a finance ministry thing. So what do you have to say on that?
Yeah, let's look at layers, okay, over here. I think the villain over here is in the narrow sense of saying, did you manipulate the close in order to benefit from it? The answer seems to be yes. And so there is a villain part in Jane Street as well. I think that is a clear thing. But then my question is larger. You benefit from the close from a substantially higher derivatives position. You don't allow this to happen in stocks. Why are you allowing it to happen in indexes? So why don't you have position limits on indexes in futures or options at an overall level. Maybe it's 5x or 10x the stock level. I don't care. But if it's not something related to the stock level, you're always going to have this problem. The second one I would say is you should consider that if the options are going to be settled for cash, people are going to leave open options positions and manipulate this cash market. Why don't you go down the US way of saying, listen, just the way stocks options are exercised into stocks, why don't we convert the index options to index futures or a basket of stocks or something like that, which then results in delivery, and that would basically, of course, it will make the whole options market a lot less liquid immediately, because the poor 500 rupee guy can't come in and pay a 15 lakh rupee price for these options. But still, it might be a way to limit expiry date trading by saying, I will devolve the options into either stocks or into index futures. Index futures expire at the end of the month. This is only for weekly options. The end of the month is not so much a problem anyways. But the weekly options can devolve into index futures, and then basically remove this incentive for someone to mark the close in the first place. That's the second layer. Now, I'd say FinMin also has a role to play. They have differential STT on stocks, indexes, futures. I say, you know what? I mean, it benefits us, of course, as a PMS or as a mutual fund to completely remove or do away with the STT on stocks. The simple idea here being STT on stocks was applied basically saying, oh, we won't tax any capital gains on stocks. But now you've removed that capital gain, removed that benefit, saying capital gains on stocks are taxed. So why don't we then remove the STT on, and you might say, listen, Deepak, so much money is being traded in options. That's ridiculous to remove STT. Guess what? You can keep those, because that's a fractional amount. But reduce or remove completely the STT on stock purchases, so that the stock market can grow in size, become more comparable to whatever it is happening over there. And if you gave a differential STT benefit to buying stocks, people would buy stocks a lot more than they do right now. So it costs 0.2% to get in and out. Make that 0.00002%, and suddenly you'll find a lot more activity happening. I think it drives some activity from that perspective. The other area that I think you have, these are the 2 or 3 big areas that I think you have. We do need an index regulation mechanism that allows for more competition in the manufacturing space for indexes. The manufacturing, and this may be partly SEBI, partly of the exchanges themselves, is that they need a self-regulatory mechanism to say, well, if I have a lot of volume trading this stuff, I need third party to come in and validate this. And these third parties can be either by competition, allow multiple players to do this, or bring third party governance to kind of take care of this whole thing. And the layer the government can also look at is the FII classification of index options trading or options trading in general as capital gains is disproportionately benefiting the FII the foreign investor compared to the domestic investor. So either equate them, say call it capital gains on both, which would be fine, or call it business income on both, which would also be fine. But I think you have to bring some kind of equivalence so that the domestic players can come and compete with Jane Street. So it's not Jane Street being the house. It is Jane Street plus something, and the something and something can be Indian names, domestic names. You bring in more competition into the space. Of course, I think at some level, India has always wanted some kind of protection in terms of capital, right? So we've always said, oh, you can't create you can't have foreign investment in multi-brand retail, which is like a retail shop, a kirana shop. Why? Because those people have so much capital, they'll come and flood out all the kirana shops in India. So you go to a Thailand, you go to Singapore and all that, they're not actually local chains, if you may. If you go to the French, there's Carrefour, there's Tesco in the UK. These are large brand chains built domestically. They're owned domestically as well. But in India, if you allowed the foreign brand companies to come, you would see 7-Elevens everywhere, you would see Walmarts everywhere, but you wouldn't see a domestic brand. You're seeing this in online, by the way. Amazon and Flipkart, which is owned by Walmart, are pretty much the biggest players, and you don't have any, and they pretend to be market places rather than retail. But everybody knows what that goes. But in general, the idea that in domestic retail should be owned by domestic players is great, because I think if you have a relationship with a foreign country that maybe at some point gets sour, you don't want your whole public to suffer saying, I can't get you bread anymore because those people have shut shop, right? So it would. This is something that we've said, okay, we need domestic protection. You guys have too much capital. So until our guys get enough capital, we're not going to allow you to compete. We've done that in the car market. We've done that in the retail market. Now think of a similar things. Jane Street comes in 15,000 crores. Our domestic capital companies don't have that much. So
or aren't allowed to use it.
Aren't allowed to use it. Yeah, so either we should allow them to use it and say, well, you know what? A lot of you Indian people are rich. Why don't you guys set up companies that rival Jane Street, and I'll give you the same advantages that they've given them. I'm not giving you more advantages. I'm not even saying ban the Jane Street. I'm saying give us a level playing field so that we can compete with them. The same tax structure, the same structure that allows them to do this magnificent thing with more. And there is a reason to protect, not because you want to protect anything, but to say that, listen, at least I should give you the same level playing field until such time as you've developed enough capital. In fact, guess what? You can have domestic hedge funds raise capital from abroad to do this. Right now, they're not allowed to do it. You can't really raise capital from abroad meaningfully and then create like a hedge fund company, because there is this rule of, if you get FDI into a company, it should not go downstream investments into other companies without kind of government permission. But if you're doing intraday trading of stocks to do arbitrage, you're actually buying into other companies and selling them, right? So in that sense, getting FDI to do this would violate some other rule, and the government needs to make it a little bit easier than anything else.
NBFC, get rid of the NBFC thing.
Oh yeah, the RBI 50-50 rule. So if a domestic company, for instance, you go and do this stuff, let's say you're really successful. I don't know how Jane Street has done this, but at some level, if you keep doing this, you hit a rule called the 50-50 rule. If more than 50% of your assets and 50% of your
income or revenue, one of the two. I think it's profits.
Income, I think, comes from financial stuff. And financial stuff it does not include fixed deposit, but it includes
arbitrage funds, liquid funds.
It includes mutual funds, stocks, derivatives. You have to go to RBI for an NBFC license. This applies even if you have like 1 rupee of revenue and 1 rupee of assets, technically, because they don't have this thing. But I would say this is a little unfair. We should not have such a rule, or we should have a much more diluted rule that does not have a 50-50 implication, because otherwise nobody can set up such a business without the fear that tomorrow RBI can come and shut you down anytime they want. I think that fear should be removed, and we should kind of this thing. So now, of course, we generally ask for the moon, but the moon is effectively saying, oh, SEBI, NSE, FinMin, RBI, all of them have to act to kind of this thing. But I think this has a systemic challenge, and I think the systemic challenge should be taken by each part of their players that do this. I feel we will only learn from extremes, those extremes that come. But it does not mean that we can't learn and improve. And if all we are saying is, listen, don't ban them, just give us an even playing field. You have an all lopsided market. Do some limits the same way you do limits on stocks. Do the limits on index options and remove the STT on stocks so that the stocks can trade a little more, so that they can become less lopsided as a market. I don't think these are unfair things to ask for, but the visibility of it is now more apparent because Jane Street has done this to us.
No, fair. And I think the point is that, look, the Indian market keeps growing, right? I mean, in the earlier you were talking about how those Reliance Petroleum shares, that those few hundred crores completely tanked the market back then. The markets are significantly bigger today by so much more. And so the fact is that our markets have become bigger. The SIP flows are apparently more than enough to counter any amount of FPI inflows, if that's the right word. So the fact is that we should allow domestic markets to develop, get more sophisticated, so that you don't end up in these situations where a foreign player, which is much more lightly regulated, is able to enter, take advantage of the rules and some loopholes or some inadvertent consequences of taxes or non-monetary income, some area, and be the only one who can really do this, while everyone here is unfortunately left sitting on their hands because they're just not allowed to play in the same way. Yes,
I completely agree. I think you've summed it beautifully. I think that's this thing. I hope. Less. I think more of such things will open our eyes into what can change. But I think it's time for change. It's time for us to
evolve
grow.
the market and grow even further. All right. Well, thank you so much, Deepak. And I guess we have to do the next one after either the first case or the SAT.
Wherever it happens.
Wherever
Yes,
it happens.
yes.
Yes.
I mean, I don't think. I don't think it's such a big deal that we should, as in this thing. But I think there will be a very interesting point where more data will come. Not less, because SEBI said this is an interim order. It's not the final order, and they're investigating other such instances. They've shown 3 instances: Jan 2024, July 2024, and May 2025. So there are more weekly options that have traded in the middle. So I expect more data to come.
And I'm very curious, what is an unfair trade? I think I'm waiting for that definition to be tested and revolved, so that at least we can all move on with our lives in some ways, with some comfort one way or another. Well, thank you. Well, folks, thanks so much for listening. If you have feedback, suggestions, or ideas for new topics, then do email us at podcast@capitalmind.in. And if you want to see a list of all our episodes, then visit capitalmind.in/podcast. We're available wherever you get your podcasts, including YouTube. Thanks. Till next time.